Hi everyone, welcome back to Sharply's YouTube channel. I am Arya Nambiar and today we are diving into a powerful investment strategy that's typically used by large institutions. It's called factor investing. You might be wondering, why is this strategy usually limited to big players? Well, it's because it requires a lot of calculations and a large amount of data to implement effectively. But here's the good news. In this video, we are going to break down the building blocks of factor investing. And I'll show you how to create your own strategy step by step. By the end of this video, you'll be able to validate your strategy with back testing, just like the pros. This is your chance to access a strategy once limited to the experts and make it your own. So stick with me until the end, because not only will you learn the secrets of factor investing, but you'll also discover how to apply them with the powerful tools available right here on Sharply. In this video, we will understand what factor investing is and what are some widely used factors, how you can use them to create a strategy of your own, and mistakes to avoid while implementing factor investing based decisions. So without wasting any time, let's dive in. First thing first, what exactly is factor investing? Simply put, it's a strategy that focuses on key characteristics or factors that historically drive better risk-adjusted returns. Instead of trying to pick individual winners, factor investing helps you capture market anomalies, like undervalued stocks or companies with high momentum. The core belief of factor investing is that you take exposure to a particular factor, and in return, you get an excessive return for that exposure. Sounds too complicated, right? Let's take some examples to simplify this. Let's look at some core factors that drive returns in the market. Each factors represent a different characteristics that has been proven over time to generate excellent returns. Value investing focuses on stocks that are underpriced relative to their fundamentals, such as earnings or book value. The idea is that these stocks are overlooked by the market, offering opportunities for growth once their true value is recognized. It is proven that undervalued stocks generate better returns than overvalued stocks. An excellent example here can be ONGC, with a PE ratio of just 7.89. ONGC is often seen as undervalued in the energy sector. Despite the market volatility, it has delivered solid returns of nearly 49% over the past year. For long-term investors, value stocks provide stability and growth opportunities when other parts of the market underperform. The second is momentum. Momentum investing captures stocks that have shown an upward price trend over a certain period of time. The theory here is that stocks that have performed well recently tend to continue performing well in the next term due to investor sentiment and market trends. So high momentum stocks will generate better returns than low momentum stocks. Third is quality. Quality focuses on companies with solid fundamentals, high profitability, low debt, and stable earnings. These companies tend to be more resilient during downturns and generate consistent returns over time. So high quality companies will perform better compared to low quality ones. A great example in India is Asian Paints Limited. It has a solid ROE of over 31% and consistent revenue growth. Despite short-term fluctuation, Asian Paints has been a long-term performer with an impressive track record. For conservative investors who prefer low-risk, buy-and-hold strategies, high-quality stocks like Asian Paints are the way to go. There are other factors like the size of the company and volatility. However, these three factors are widely used by institutions to create strategies that outperform the market. As an investor, there are two main ways to approach factors investing. First, you can go with a single factor strategy. For example, focusing only on value or momentum. This works great if you have a particular view on where the market is headed. But many investors prefer a multi-factor approach, where you combine factors like value, momentum, and quality. This way, you diversify your risks and smooth out performance. Now the big question, how do you create factor investing based investment strategy? On Sharply, we have made a special tool for this. We call it the factor model. Here, based on your preference, you can select factors from more than 300 metrics. Now let's create a strategy of your own. Let's say you want to create a multi-factor strategy that combines quality, value, and momentum. For instance, you can either use metrics like ROE and ROCE for quality, PE ratio, PB ratio for value, and 1-month return for momentum. Or you can use our stock scores. We have created these scores using multiple metrics. In short, we have done the heavy lifting of processing the data for you. So click on the Add Factor button and then go to Stock Scores. Then select Value Score, Quality Score, and Price and Earnings Momentum Score. The next step is to select the weights of these factors. Let's say we are more focused on momentum. So we will increase the weightage of the momentum score to 60%. And rest two factors will have a weightage of 20% each. Then you click on the Run Model. Now, based on your selected universe, you will be able to see the scores of all the stocks in descending order. You won't be investing in all 500 stocks. So let's just select the top 15 stocks based on the model. And that's it. You have created a factor investing based investment strategy. Let's check how it is performing. And for that, we will simply click on the Backtest button. And as you can see, the portfolio is outperforming the benchmark. You can also change the strategy parameters like rebalancing frequency and asset allocation from the backtest parameter section. Now let's look at the other side of the coin. Factor investing can be powerful, but there are some common pitfalls you need to avoid to make the most of it. Let me highlight a few mistakes that even experienced investors make and how you can steer clear of them. The first mistake is relying too heavily on past data trends. Just because a factor worked well in the past doesn't guarantee it will work in the future. Market evolve and sticking rigidly to outdated pattern could hurt your returns. For example, if you see that ONGC has done well over the past year, don't assume it will keep rising without considering current market conditions like oil price movement. Another mistake is putting all your eggs in one factor's basket. Relying solely on momentum or value stocks can leave you exposed to unnecessary risks. Diversifying your portfolio across multiple factors like mixing ONGC, trend, and Asian Paints helps balance out performance and reduce volatility. And the third mistake is not reviewing your strategy regularly. Markets change and so should your strategy. It's important to review your portfolio regularly and rebalance your factors allocations. For instance, if the economy is slowing down, you might want to shift some funds from momentum stocks like trend to value plays like ONGC. By avoiding these common mistakes, you will stay ahead of the curve and keep your portfolio on the right track. Remember, factor investing is all about consistency and discipline, not chasing short-term gains. Well, viewers, start exploring sharply today and build a strategy that works for you. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more actionable investment advice. Let us know in the comments which factors will you be testing in your portfolio. Till then, thank you for watching.